Let me tell you about the biggest mistake most investors make. They trust people. I know that sounds cynical. I know it sounds harsh, but in my 40 years of investing, buying companies, and working with entrepreneurs on Shark Tank and beyond, I've learned one fundamental truth. People give themselves away every single time. The fraudsters, the cheats, the people cooking the books, the ones inflating their numbers, the ones selling you a dream while picking your pocket, they all give themselves away. You just have to know what to look for. I'm Kevin O'Leary, and today I'm going to teach you exactly how to spot fraud, deception, and financial manipulation before you write a check, before you make an investment, before you lose your money. Because I've seen it all. I've been pitched by the best con artists in business. I've reviewed thousands of business proposals. I've invested in hundreds of companies. And I've learned to filter out the 90% who are lying, exaggerating, or deluding themselves. And you can too. Once you know the tells, once you understand the patterns, once you learn to trust your instincts when something doesn't add up, today I'm going to share the exact framework I use to evaluate people and businesses. The red flags that make me walk away, the signs that someone's playing games with numbers, and the questions I ask that make fraudsters squirm. This isn't theory. This is practical knowledge that has saved me millions of dollars and protected me from countless bad deals. Pay attention, because what I'm about to teach you could be worth more than any investment advice you'll ever receive. Let me start with something fundamental. When someone comes to me with a business opportunity, I'm not primarily evaluating the business. I'm evaluating the person. The business might be great on paper. The numbers might look fantastic. The market opportunity might be enormous. But if the person is dishonest, manipulative, or delusional, none of that matters, because they will destroy value. They will cook books. They will make decisions that benefit them at your expense. So how do I evaluate people? How do I separate the honest entrepreneurs from the fraudsters? It starts with what they talk about, what they emphasize, what they think is important. When someone walks into the room and immediately starts talking about how easy the business is, how it's like taking candy from babies, how the returns are guaranteed, I know I'm dealing with either a fraud or an idiot, and I don't invest in either. Real businesses are hard. Building a company is brutal. Generating returns requires skill, effort, and usually some luck. When someone makes it sound easy, they're either lying to you or lying to themselves. Either way, your money is at risk. I learned this lesson from studying Warren Buffett and Charlie Munger. These guys have been investing for over 70 years combined. They've seen every scam, every scheme, every type of fraud imaginable, and they've developed a simple filter. If it sounds too good to be true, it is. Charlie tells a story about someone pitching them an insurance program. The pitch was, we only write fire insurance on concrete bridges covered by water. It's like taking candy from babies. That phrase right there, like taking candy from babies, is a massive red flag, because nothing in business is that easy. If it were that easy, everyone would be doing it. If it were that simple, competition would eliminate the excess returns. When I hear language like that, when I hear people downplaying the difficulty or the risks, I immediately get suspicious, because honest people know how hard business is. They know the challenges. They talk about obstacles, competition, execution, risk. Fraudsters and promoters talk about how easy it's going to be, how the returns are guaranteed, how you can't lose. Let me give you another tell. Watch what happens when you ask difficult questions. When I'm evaluating a business, I ask hard questions about their margins, about their competition, about their customer acquisition costs, about what happens if their key assumptions are wrong. Honest entrepreneurs welcome these questions. They've thought through the issues. They have answers. They might not have perfect answers, but they engage seriously with the questions. Fraudsters get defensive. They deflect. They change the subject. They tell you you're being too negative or too conservative. That defensiveness is a tell. It's a sign that they don't have good answers, that they haven't thought it through, or that they're hiding something. I've walked away from deals worth millions of dollars because the entrepreneur got defensive when I asked basic questions about their business model. Because if they can't handle tough questions in a pitch meeting, how are they going to handle the brutal reality of running a business? Now, let me talk about financial fraud specifically, because this is where a lot of people get taken advantage of. There are certain patterns in financial statements that scream fraud, certain manipulations that show up again and again. One of the most common is reserve manipulation in insurance companies and banks. Reserves are estimates of future liabilities, how much the company expects to pay out in claims or loan losses. Because they're estimates, management has some discretion in setting them, and that discretion creates opportunity for manipulation. I've seen insurance companies lower their reserves right before going public or selling to another company. Why? Because lower reserves mean higher reported profits. Higher profits mean higher valuation. Higher valuation means more money for the sellers. Then after the sale or IPO, the reserves mysteriously need to be increased. Oops, we underestimated. Profits drop, stock price crashes. Original owners have already cashed out. This happened repeatedly in the 1980s and 90s with insurance companies. It still happens today in more subtle forms. When I look at an insurance company's financials, I look at reserve trends. If reserves are dropping as a percentage of premiums, I ask why? What changed? Is the business genuinely getting better, or are they manipulating reserves? Often, you can spot the manipulation by looking at what happens after an acquisition or IPO. If reserves suddenly jump up, that's evidence they were artificially low before. Another common fraud is revenue recognition games. This is especially prevalent in software and subscription businesses. Companies will recognize revenue upfront for multi-year contracts. They'll book revenue before services are actually delivered. They'll include barter transactions or related party transactions at inflated values. All of these inflate current revenue and profits while creating future problems. How do you spot this? You look at the relationship between revenue, cash flow, and accounts receivable. If revenue is growing rapidly but cash flow isn't growing proportionally, that's a red flag. It suggests revenue is being recognized before cash is actually collected. If accounts receivable is growing faster than revenue, that's another red flag. It suggests customers aren't actually paying for the services being booked as revenue. I've seen companies with spectacular revenue growth and terrible cash flow. They're technically profitable on an accounting basis, but they're burning cash because customers aren't actually paying. That's not fraud in the legal sense, but it's deceptive. It's presenting a picture of success that doesn't reflect economic reality. Let me tell you about a pitch I received recently. This is a perfect example of the games people play with numbers. A private company earning, let's say, $100 million a year wanted to sell. Their investment banker suggested we should value them based on earnings of $110 million. Why the extra $10 million? Because as a private company, they had to pay executives in cash, which was expensed, but we could pay them in stock options, which under the accounting rules at the time weren't expensed or were explained away. So they wanted us to pay them for earnings we could only achieve by giving away equity we didn't want to give away and by using accounting that was essentially dishonest. Think about the logic. They're saying you should pay us more because you can lie about your accounting better than we can. At that point, I'm done. I don't care how good the business is. I don't care what the returns might be, because I'm dealing with people who think accounting manipulation is a legitimate business strategy. And if they're willing to manipulate accounting to get a higher price from me, they're absolutely willing to manipulate accounting in running the business. Here's another example. We received a proposal from a private equity firm. They included projected financials for the business they were selling. By mistake, we got forwarded an internal email from the private equity firm to the company's management. The email instructed management to increase all projections by 15%. Why 15%? Because Buffett discounts everything by 15 to 20% anyway, so just add 15% to offset his conservatism. Think about that. They're explicitly telling management to inflate projections because they assume the buyer will discount them. This is the game. Everyone knows everyone else is lying, so everyone lies more to compensate for the expected discounting of the lies. It's insane, and it's everywhere. This is why I've developed such a strong filter. I assume everyone is exaggerating. I assume projections are inflated. I assume the best case scenario they're presenting is actually the middle case, and the middle case is actually the likely case. And even with those assumptions, I still get surprised by how often reality underperforms projections. So how do you protect yourself? How do you avoid getting taken in by frauds and deceptions? First, trust your instincts. If something feels off, it probably is. I can't tell you how many times I've ignored a gut feeling and regretted it. Your subconscious picks up on things your conscious mind hasn't fully processed. When someone makes you uncomfortable, when their answers don't quite add up, when they're too smooth or too evasive, trust that feeling. Second, look for internal consistency. Fraudsters often tell different stories to different audiences. Compare what they're telling you to what they've told others. Look at their website, their press releases, their past pitch decks if you can find them. If the story keeps changing, if the numbers don't match, if they're emphasizing different things to different people, that's a red flag. Honest people tell a consistent story because they're telling the truth. Liars have to remember which lies they told to which people. Third, verify everything independently. Don't take their word for anything that can be checked. They claim they have a patent? Check the patent database. They claim they have major customers? Call those customers. They claim they're growing rapidly? Ask for access to detailed financials and verify the numbers. I've caught so many lies simply by checking claims that most people take at face value. Someone claims they have a partnership with a major corporation. I call that corporation. Half the time, they've never heard of the company, or the partnership is just an application to their vendor program. Someone claims they're growing at 200% year over year. I asked to see monthly revenue numbers for the past 24 months. Suddenly, the growth rate looks a lot less impressive when you see how lumpy it is and how much was driven by one-time events. Fourth, pay attention to how people react to scrutiny. Honest people welcome it, fraudsters resist it. When I start doing due diligence, honest entrepreneurs help me. They provide documentation, they answer questions, they facilitate conversations with customers and partners. Fraudsters obstruct. They make excuses for why I can't talk to certain people. They claim documents are proprietary or not available. They get angry that I'm asking so many questions. That resistance is a tell, because if the business is as good as they claim, scrutiny should validate their claims. The fact that they're afraid of scrutiny tells you they know it won't hold up. Fifth, understand incentives. Always ask yourself, what is this person's incentive to lie? If someone is selling a business, they have an incentive to inflate value. If someone is raising money, they have an incentive to exaggerate potential. If someone is trying to hit a performance milestone, they have an incentive to manipulate numbers. Understanding incentives helps you understand where the lies are likely to be. When an insurance company is about to go public, I know they have an incentive to manipulate reserves to boost reported profits. So I look extra carefully at reserves. When a company is trying to raise money, I know they have an incentive to inflate projections. So I discount projections heavily and focus on historical performance. When a private equity firm is trying to sell a business, I know they have an incentive to present optimistic scenarios. So I ask for worst case and base case scenarios, not just best case. Let me share a specific technique I use. I call it the stress test. When someone presents me with projections or a business plan, I ask them to walk me through what happens if their key assumptions are wrong. What if revenue comes in 20% lower than projected? What if costs are 10% higher? What if customer acquisition takes twice as long as expected? Honest people have thought through these scenarios. They can walk you through the implications. They have contingency plans. Fraudsters haven't thought about it because they're not planning to be around when reality diverges from their projections. They're selling you the dream and getting out. The way someone responds to this stress test tells you everything about whether they're serious business people or promoters. I also pay close attention to culture and team dynamics, because fraud doesn't happen in isolation. It requires a culture that tolerates or encourages deception. When I'm evaluating a business, I try to talk to employees beyond just the CEO. I want to understand how decisions are made, whether there's open debate or whether the CEO is a dictator, whether people are comfortable raising concerns. Companies where fraud occurs typically have authoritarian CEOs who don't tolerate dissent. Everyone below them learns to tell the boss what they want to hear. Numbers get massaged to make targets. Problems get hidden until they explode. Healthy companies have debate. They have people who challenge assumptions. They have systems for surfacing problems early. You can often spot the difference by observing a few meetings or conversations. Now let me talk about something important: the difference between fraud and optimism bias. Not everyone who gives you inflated projections is a fraud. Many are just overly optimistic. They genuinely believe their optimistic case will happen. How do you tell the difference? Fraudsters know they're lying. Optimists believe their own story. The way you tell the difference is by looking at what they do with their own money. If someone is pitching me an investment and they're not investing their own money, that's a massive red flag. Because if the opportunity is as good as they claim, why aren't they mortgaging their house to invest more? If they're selling their shares while telling others to buy, that's fraud. If they're keeping their shares but genuinely believe the optimistic scenario, that's just bias. I'm more forgiving of bias than fraud, but I still don't invest based on biased projections. Let me share some specific red flags I've learned to watch for over the years. Red flag number 1, complexity without justification. When someone makes a simple business complicated with unnecessary structure, that's often to hide something. I've seen businesses with multiple layers of holding companies, offshore entities, related party transactions, all creating complexity that serves no legitimate purpose. Why the complexity? Usually to hide where money is really going, to obscure who owns what, to make it difficult to understand the real economics. Legitimate businesses are as simple as possible. Complexity is expensive and creates risk. When I see unnecessary complexity, I assume it's there to deceive. Red flag number 2, aggressive accounting. When a company is using every trick in the book to boost reported earnings that tells you management is focused on appearance over reality. I look at things like, are they capitalizing costs that should be expensed? Are they using aggressive revenue recognition? Are they understating reserves or liabilities? Are they using one-time gains to boost operating results? Any company can play these games occasionally. But when you see a pattern of aggressive accounting across multiple areas, that's a cultural problem. It means management values reported numbers over economic reality, and that creates enormous risk. Red flag number 3, changing auditors. When a company changes auditors, especially if they're moving from a reputable firm to a lesser-known firm, I want to know why. Often it's because the reputable firm was asking uncomfortable questions about accounting practices. The company fires them and hires a more compliant auditor. This happened at Enron, WorldCom, and numerous other frauds. The auditor started pushing back on aggressive accounting, so they got replaced. Red flag number 4, related party transactions. When a company is doing significant business with entities owned by management or board members, I get very suspicious. These transactions create opportunities to shift money around in ways that benefit insiders at the expense of shareholders. I'm not saying all related party transactions are fraudulent. Sometimes they're legitimate, but they require extra scrutiny because the incentives are so misaligned. Red flag number 5, stock-based compensation games. This is the example I mentioned earlier where companies try to not expense stock options or to value them artificially low. Stock-based compensation is a real cost. It dilutes shareholders. When companies try to pretend it doesn't count or doesn't matter, they're being dishonest about the economics of their business. I've walked away from numerous tech investments because the amount of stock-based compensation made the business far less profitable than it appeared. Red flag number 6, non-GAAP metrics. Companies increasingly report non-GAAP earnings alongside GAAP earnings. They adjust for various items to present a more favorable picture. Some adjustments are legitimate. One-time charges, acquisition costs, things that genuinely aren't representative of ongoing operations. But many companies abuse non-GAAP metrics to paint a misleading picture. They adjust out everything that makes them look bad and present adjusted earnings that bear little relationship to economic reality. When I see a big gap between GAAP and non-GAAP earnings, I dig deep into the adjustments. Often I find they're adjusting out things that are actually recurring costs that absolutely should count. Red flag number 7, promotional behavior. Some CEOs spend more time promoting their stock than running their business. They're constantly on CNBC, they're tweeting about how great things are, they're presenting at every investor conference. Meanwhile, operational metrics are deteriorating. Customer satisfaction is declining. Employee turnover is increasing. This promotional behavior is often a sign that management knows the stock is overvalued and they're trying to keep it elevated as long as possible so they can sell their shares. Honest CEOs focus on building the business. They let results speak for themselves. Now, let me share a framework that Warren Buffett and Charlie Munger use that I've adopted. They filter out 90% of opportunities immediately. They're not trying to identify every good opportunity. They're trying to avoid bad ones. Their goal is to only invest in situations where it's completely obvious that the business is good and the people are trustworthy. Everything else they pass on, even if they might be wrong about some of those, because the cost of investing in a fraud or a bad business is much higher than the cost of missing a good opportunity. I've adopted the same approach. I say no to 95% of opportunities that come my way. Not because they're all bad, but because I'm not confident I can assess them accurately. And I'd rather miss opportunities than invest in frauds. This approach has saved me from countless disasters. Yes, I've probably missed some good investments, but I've avoided far more bad ones. Let me tell you about the importance of reference checks. This is something most people don't do thoroughly enough. When I'm considering investing in someone's business, I don't just call the references they provide. Of course, those people will say good things. I call people who aren't on the reference list. Former employees, former business partners, competitors, customers. I ask open-ended questions. What's it like working with this person? What are their strengths and weaknesses? Would you do business with them again? The answers are incredibly revealing because people who aren't on the reference list are much more honest. I've discovered fraud, ethical problems, operational incompetence, all through calling people who weren't official references. This due diligence takes time. It's not glamorous, but it's essential. Another technique I use is scenario planning. I ask the entrepreneur to walk me through 3 scenarios: best case, base case, and worst case. Most entrepreneurs only want to talk about best case. They're selling the dream. But how they handle the worst case scenario tells me whether they're serious business people or just promoters. Serious entrepreneurs have thought about what happens if things go wrong. They have contingency plans. They know where they can cut costs, how they can pivot, what their survival cash burn looks like. Promoters haven't thought about worst case because they're planning to sell their shares before worst case arrives. I also look at capital allocation decisions. How has management used capital in the past? Have they made smart acquisitions? Have they returned cash to shareholders when they don't have good reinvestment opportunities? Have they avoided wasteful spending on prestige projects? Or have they made overpriced acquisitions? Wasted money on corporate jets and fancy offices? Pursued empire building over shareholder returns? Capital allocation reveals character. It shows whether management is focused on building value or building empires. Let me share something Charlie Munger taught me. He said the key to investing is not getting taken advantage of. It's not about finding the best opportunities. It's about avoiding the frauds, the promoters, the people who will take your money and destroy value. If you can simply avoid being defrauded, you'll do better than most investors. Because the losses from fraud are catastrophic. You don't lose 20 or 30%. You lose everything. One fraud can wipe out years of gains from good investments. This is why I'm so paranoid, why I'm so suspicious, why I have such high standards for the people I invest with. Because I've seen too many people lose everything to frauds. Smart people, sophisticated investors, people who should have known better, they got taken in because they wanted to believe, because the returns sounded great, because they didn't do the hard work of verifying and questioning. I'm also very careful about conflicts of interest. When someone pitching me an investment has a financial incentive to close the deal, regardless of whether it's good for me, I'm extremely skeptical. Investment bankers get paid when deals close. Brokers get commissions when you invest. Private equity firms get fees based on assets under management. All of these people have incentives to get you to invest, even if the investment isn't good for you. I never rely on someone with a conflict of interest to evaluate an opportunity. I do my own work or hire independent advisors who are paid regardless of whether I invest. Let me end with some practical advice for anyone evaluating a business opportunity or investment. First, slow down. Fraudsters create urgency. They want you to decide quickly before you have time to think clearly or do proper due diligence. Whenever someone pressures me to decide quickly, I automatically slow down because legitimate opportunities don't disappear overnight. Second, get everything in writing. Verbal promises mean nothing. If someone won't put something in writing, that tells you they're not serious about it. Third, use professional advisors. Lawyers, accountants, industry experts, people who can help you spot issues you might miss. Fourth, trust is earned over time. Don't trust someone just because they seem successful or credible. Watch how they behave over months and years. Fifth, remember that past performance doesn't guarantee future results. Just because someone has been honest in the past doesn't mean they'll be honest now. Incentives change, pressure changes behavior. And finally, never invest more than you can afford to lose. No matter how good it looks, no matter how much you trust the person, there's always risk. The world is full of fraudsters, promoters, and people who will take your money given the chance, but they all give themselves away if you know what to look for. Watch what they talk about, how they react to questions, how they handle scrutiny, what they do with their own money. Trust your instincts, do your homework, and remember that avoiding fraud is more important than finding opportunity.